Assalamu alaikum dear students. I hope you all are fine and safe. I am Dr. SM Ali Tirmizi, your teacher and guide of corporate governance course. Today we will discuss chapter number 11, that is the market for corporate control. The main topics that we will cover in this chapter are listed in the next slide for your reading and understanding. I hope you will find this video lecture useful to learn and clear topics as well as concepts discussed in the chapter number 11, lecture of corporate governance. In chapter number 11, the market for corporate control, the major topics that will be covered starts with the introduction of the chapter. Then we will discuss the second topic, that is details relating the market for corporate control. The third topic of the lecture is stock market assessment of acquiring and target firms. The fourth topic is anti-takeover protections. Then we will discuss anti-takeover actions as the fifth topic of this lecture. The last and sixth topic of the lecture is warding off unwanted acquirers. At the end of this lecture, I will discuss with you the Harvard Business Review article reading assignment as well as details relating pending quizzes of chapter number 8, 9, 10 and 11. These and related details have been shared on the Corporate Governance Microsoft class platform. You are also informed that from 20th of July 2020, that is the next month, your final semester exams are approaching, and I want all of you to prepare chapters covered so far to obtain highest marks in the corporate governance course. In the beginning of the chapter, we start our discussion by examining the market for corporate control. Here we will further discuss concepts of the market for corporate control, means of corporate control, acquisition and its objectives, YouTube video relating review of merger and acquisition around the globe, private equity, non-strategic regions of mergers and related practical examples. Therefore, in general, in this lecture, we will try to answer the questions relating how beneficial are acquisitions, do they create or destroy value? Then we examine the steps companies take to protect themselves from unsolicited acquisitions. When is it appropriate for the firm to adopt anti-takeover protections? Do they lead to enhanced shareholder value, or are they a source of value-destroying friction? All these questions have been answered from topic to topic in this lecture. It's a well-known fact that a well-functioning governance system consists of more than a board of directors to provide oversight for the corporation and an external auditor to ensure the integrity of financial reporting. It includes all disciplining mechanisms, legal, regulatory, and market-driven that influence management to act in the interest of shareholders. So instead of removing an executive, the board of directors, or in some cases shareholders directly, can decide to transfer ownership of the firm to new owners who will manage its assets more profitably. A change in control involves not only replacing management, but also possibly making substantial changes to firm strategy, cost structure, and capital structure. In theory, a change of control makes economic sense only when the value of the firm to new owners minus transaction costs associated with the deal is greater than the value of the firm to current owners. When this scenario occurs, the acquirer will attempt to purchase the target and capture the resulting economic gains. This general idea is called the market for corporate control. Class, now we will discuss the second topic of this lecture, which is the market for corporate control. The concept of a market for corporate control was initially put forward and described by Henry Mann, which is the lower the stock price relative to what it could be with more efficient management, the more attractive the takeover becomes to those who believe that they can manage the company more efficiently. So a lower stock price indicates poor management of company's assets and provides incentive to outside investors to find alternative sources of capital to acquire the company, replace its management, and maximize its resources for their own gain. Now, further discussion on the topic of the market for corporate control. Evidently, today we think of market for corporate control as consisting of all mergers, acquisitions, and reorganizations, including those by a competitive firm, by a conglomerate buyer, or through a leverage buyout, management buyout, or private equity firm. The company that makes the offer is known as the acquirer or bidder. The company that is the subject of the offer is the target. An acquisition attempt can either be friendly or hostile. Friendly acquisitions are those in which the target is open to receiving an offer from the acquiring firm. An acquisition might still be considered friendly if the target rejects the initial bid as inadequate but signals that it is willing to negotiate a higher takeover price. Hostile takeovers are those in which the target resists attempts to be acquired at any reasonable price. Management of the target firm might adopt a defense mechanism to protect itself from a takeover, or more likely, it might already have such a mechanism in place that management declines to remove. These are known as anti takeover protections or anti takeover defenses. Now, relating the concept of corporate control, the most frequently cited reason is that the acquiring firm believes it can enhance the profitability of the target company in a manner that the company could not achieve in its existing ownership structure. In this way, the firm's assets might be worth more to an acquirer than the company as a freestanding entity. Acquisition by the acquirer is normally with the intention for number 1, financial synergies, number 2, diversification, number 3, change in ownership. We will discuss these intentions in detail. In the case of financial synergies, an acquiring firm believes that it can increase profits through revenue improvements, cost reductions, or vertical integration that comes from combining the two companies' business lines. But in the case of diversification, two companies whose earnings are uncorrelated, for example, because they are in unrelated or counter-cyclical industries, might benefit by merging because the capital generated when one business is thriving can help the other when it is under pressure. This is the logic behind the conglomerate structure. Conglomerates can also transfer non-cash resources such as management among divisions. However, in the case of change in ownership, a new ownership group might be able to improve the profitability of the target through its access to capital, managerial expertise, and other business resources. For example, private equity firms dramatically change the capital structure and incentive plans in the target firm after acquisition. Now class, watch an online video relating review of mergers and acquisitions around the globe.
I would like to welcome you to the annual M&A Review 2019. We project that about 47,000 M&A deals will be announced by the end of 2019. This will represent a decrease of 12% compared to last year. The known value of transaction will reach $3.5 trillion US. Compared to last year, the value has actually declined even further by minus 14%. Of course, not all regions are affected by the same trend. Let's have a look at the various regions. North America is still by far the largest M&A market in the world in terms of value of transactions. The number of deals have dropped to almost 15,000, representing a decline of 15%, which is in line with the global trend. The value, however, dropped by only 7% to $1.9 trillion US. For example, some of the biggest deals include a lot of mergers, like United Technologies merged with Raytheon for $87 billion US, Bristol Myers merged with Celgene for $79 billion, or AbbVie's merger with Allergan valued at $62 billion US. Let's have a look at Europe. Europe is the largest M&A market based on the number of transactions. The number of deals are down to 16,200 transactions, which amounts to a decrease of 10% compared to last year. This is also lower than the global trend. Value of transaction actually has slumped by 25% to 970 billion US dollars. When we take a look at this value in euro instead of US dollars, the value is 870 billion euro, which is a decline of only 20%. There also has been a decline in M&A in Eastern Europe, but to a much lesser extent than compared to the West. The largest European deals are significantly smaller compared to North America. Some highlights include Fiat Chrysler's plan to merge with Peugeot, valued at 30 billion, London Stock Exchange Group's acquisition of Refinitiv in the US for 27 billion, and LVMH's acquisition of Tiffany & Co. for 16 billion. Let's move on to Asia Pacific. While the number of transactions has declined by 10% to 14,000 deals, value in US dollar decreased by almost 30% to around 800 billion US dollars. Some of the announced big transactions include Hong Kong Stock Exchange's by now withdrawn acquisition of London Stock Exchange Group for 36 billion US dollars, Asahi from Japan acquiring CUB in Melbourne from Foster's for 11 billion US dollars. If we focus on Southeast Asia, the number has gone down by 12% to 2,100 transactions, but its value has increased by 17% to 132 billion US dollars. Let's have a look at South America. The number of transactions is down by 14% to around 1,000 transactions. But contrary to the global trend, the value has increased by 11% to 80 billion US dollars. If we take a look at Gulf Cooperation Council member states, the number of deals declined by 11% to 368, while their value has rocketed by a stunning 133% to 109 billion US dollars. The value, however, has been distorted by one very large transaction, namely Aramco's 69 billion US dollar acquisition of SABIC. If we count for this, there would have been also a reduction in terms of value by 13% to 40 billion US dollars in that region too. Apart from Aramco, other big deals in this region include a 40% stake in Abu Dhabi National Oil Company's pipeline assets by BlackRock and KKR worth 4 billion US dollars, Eni from Italy acquiring a 20% stake in Abu Dhabi Oil Refining Company for 3 billion US dollars, or Uber's acquisition of Careem for 3 billion from Kingdom Holding and Saudi Arabia Telecom. Number of transactions in Africa are down by only 9% to 777 transactions. But also in Africa, the slump in value has been quite overwhelming by almost 1/3 to 27 billion US dollars. I hope you liked that overview. Feel free to reach out and discuss the challenges that you may be facing in your transactions, pre-deal and post-deal in integration. Here you find also our contact information.
Now we will discuss private equity in connection to the topic of the market for corporate control. Private equity firms are active participants in the market for corporate control. Private equity firms are privately held investment firms that acquire companies for the benefit of retail and institutional investors. A private equity investor commits to invest in a fund managed by the firm for a finite period, 10 to 12 years on average. The fund in turn invests this money by acquiring companies for an average duration of 4 to 5 years, after which the investment is sold and the invested capital returned. Because private equity firms acquire companies on behalf of institutional investors, they are referred to as financial buyers, in contrast to corporate acquirers, which are known as strategic buyers. Private equity firms are also known for the aggressive use to leverage to amplify returns over the 4 to 5 years investment period. When the market for corporate control has been exercised, companies can also merge for non-strategic reasons, such as for number 1, empire building, number 2, management hubris, number 3, herding behavior, number 4, compensation incentives. Now I'll discuss these 4 points one by one. Empire building describes a situation in which the acquiring company's management seeks to acquire another company primarily for the sake of managing a large enterprise. Hubris represents overconfidence on the part of management that it can more efficiently utilize the assets of a target to achieve greater revenues or cost savings than current owners can do. Herding behavior occurs when the senior management team of one company pursues acquisitions because its competitors have recently completed acquisitions. Compensation incentives might encourage management to pursue deals that are not in the best interest of shareholders. Management of the acquiring company might pursue a deal because the executives will receive greater compensation for managing a large enterprise. Management of the target company might want to accept a takeover bid because the executives stand to receive large severance or change in control payments. Now we'll discuss an example relating corporate control, that is empire building. Empire building might have been the driving factors behind the series of acquisitions led by former Citigroup CEO Sandy Wade, who took over as CEO of little-known commercial credit, aggressively expanded by purchasing Primerica, parent of the prestigious brokerage firm Smith Barney, Travelers Insurance, Salmon Brothers, and Citicorp to create Citigroup, at one time the largest financial institution in the world. Although improved service was often the stated motivation behind each acquisition, the emphasis was also on size. For example, upon announcing the Citicorp Travelers merger, Wills asserted, "Citicorp and Travelers Group bring together some of the best people in the financial services business, creating a resource for customers like no other, a diversified global consumer financial services company, a premier global bank, a leading global asset management company, a preeminent global investment banking and trading firm, and a broad-based insurance capability. Our ability to serve consumers, corporations, institutions, and government agencies, domestic and foreign, will be without parallel. This is a combination whose time has come." So this has been the verdict of the CEO of Citicorp. Now we'll discuss another example of the market for corporate control relating hubris. Hubris might have driven AT&T CEO Michael Armstrong in his bold acquisition strategy in the late 1990s. Armstrong joined the company in 1997 following an accomplished career at IBM and then serving as CEO of Hughes Electronics. In the next few years, he moved aggressively to accumulate a significant collection of telecommunication assets. He spent more than $100 billion on cable companies, TCI and Media One. Armstrong believed that by managing a diverse set of telecommunication assets under one roof, AT&T would be positioned to capitalize on a convergence between voice, data, and internet technologies. However, the strategy largely failed. AT&T was unable to realize revenue and profit objectives, and the company struggled under significant debt. AT&T was steadily dismantled, and the company was sold to SBC in 2005. Now we'll discuss another example of market for corporate control relating herding behavior. After pharmaceutical giant Pfizer agreed to acquire Wyeth in 2009 and Merck announced that it was merging with Schering-Plough, the Wall Street Journal predicted that a wave of acquisitions is likely as companies worry about their drug pipelines. Senior management teams might justify copycat moves in economic terms, such as a change in the competitive landscape. But herding behavior is likely also driven by psychological tendencies, including envy, social proof, a desire for media attention, and reputational factors. Investment bankers also might exploit these tendencies to encourage deal making. Now we'll discuss another example of the market for corporate control relating compensation incentives. In 2005, Gillette Company agreed to sell itself to Procter & Gamble P&G in a deal valued at $57 billion. Following the deal, Gillette CEO James Kilts received $185 million in severance and other benefits. Critics of the deal alleged that Kilts had put his own financial consideration above that of the company by agreeing to the acquisition. According to New York University professor David Yermak, many CEOs really dip in and take an extra bonus, an extra augmentation of their contract at the 11th hour when there is very little ability of the shareholders or even their own directors to do anything about it. Kiltz defended the deal by claiming that it was not done to aggrandize management or myself, but to do what is right for shareholders and employees. He pointed out that much of the gain was from appreciated equity compensation that he had accepted in lieu of cash during his tenure. Now class, we will discuss the third topic of this lecture, which is stock market assessment of acquiring and target firms. In history, many researchers have attempted to develop models that predict which companies are likely to become acquisition targets based on financial and stock price performance. However, professional studies have identified attributes that might be common across takeover targets, and these are: number one, fundamentally weak performance of the companies; number two, companies in an industry with heightened merger activity; number three, low debt levels representing companies; number four, strong cash flow representing companies; and number five is valuable assets representing companies. Now class, we will discuss the fourth topic of this lecture, which is anti-takeover protections. A company that does not want to become the target of an unsolicited takeover can adopt defense mechanisms that discourage or dissuade potential bidders from making a formal offer. Several important economic reasons justify doing so. Number one, preservation of long-term value; number two, acquirer myopia; and number three is enhanced bargaining power. Now we will discuss these reasons in detail. In the case of preservation of long-term value, a company with attractive future growth prospects that is selling at a depressed market price might want to prevent another company from making a bid at artificially low prices. For example, the firm might have developed a new technology but has chosen not to disclose this information to the public for competitive reasons. The current stock price will not reflect the value of this innovation. By remaining independent, the company will have time to commercialize this technology and deliver long-term value to current shareholders. In the case of acquirer myopia, a company that is protected from unsolicited takeovers have greater flexibility to pursue risky, long-term projects that offer attractive future gains. Management is able to make investments with positive net present value that depress current earnings without having to worry about being taken over before those investments have had time to pay off. But in the case of enhanced bargaining power, when a company implements anti-takeover protections, a potential acquirer is more likely to be compelled to engage management rather than make a hostile bid. This increases management's negotiating leverage and offers the target the opportunity to secure a higher deal price. However, anti-takeover provisions can also be a manifestation of agency problems, such as management entrenchment. Now class, we will discuss the fifth topic of this lecture, which is anti-takeover actions. The most common anti-takeover defense is the poison pill, also known as shareholders' rights plan. Many companies have this defense in place on an ongoing basis, but even those that do not can adopt one at any time without delay and without shareholders' approval. When triggered, poison pills have the potential to grant holders of the company's shares the right to acquire additional shares at a deep discount to fair market value. The poison pill is triggered if a shareholder or shareholders group accumulates an ownership position above a threshold level, typically 15 to 20% of shares outstanding. Now class, watch an online video relating poison pill, which is a defense mechanism against hostile takeovers.
continue on with our discussion of anti-hostile takeover measures or defenses against hostile takeovers, another common one is called a poison pill. Well, a poison pill is made to thwart a acquisition that's underway. Okay, so it's made so once an acquisition starts, it would cause a great deal of procedural issues or harm the value of the deal once it starts. But until the acquisition starts, it doesn't come into effect. One would be a preferred share issuance. Well, that's generally a situation where, in the event of acquirer reaching a certain level of ownership in the corporation, something like that, then shareholders, a group of shareholders are entitled to a issuance of preferred shares that have extensive rights beyond those of common shareholders, where it could effectively drain off a ton of the value of the corporation or sought to be created by the combination. So it would make the deal less valuable, or in some case worthless, or a loss for the acquirer, and can be an effective defense. Another one would be the class of share recapitalization. That is, there's common and existing shares out there, and it could allow the preferred shareholders to convert their shares to a class of common stock, which, say, a preferred class of stock is convertible into 10 common shares. Well, this could make it extremely expensive for an acquirer of shares. If they need to acquire a majority or a controlling block of shares, it can make it far more difficult for them to acquire the number of shares necessary to effectuate the hostile takeover. So again, in this way, allowing these conversion rights could again thwart or make the value of the deal to the acquirer far less. And then lots of times, the executives will have deferred compensation plans that allow for length of time for vesting of employee stock plans and things like that. Well, sometimes the bylaws or articles will allow for poison pill provisions that allow for accelerated vesting of employee stock plans, so it could run years worth of projected vesting of options or stock as compensation within a short period of time upon the acquisition of the organization or acquisition of a certain number of shares. Well, this could again cause a flood of additional shares onto the market, and could make it difficult for the acquirer to acquire the number of shares necessary to effectuate the takeover. So again, it makes the deal far less valuable or far more expensive to carry out.
Now, further discussion relating the topic of anti-takeover actions. A second layer of anti-takeover defenses include those that prevent a hostile acquirer from replacing the incumbent board, which is dual-class stock. This protection mechanism gives a controlling shareholder or management enough votes to control board elections. A dual-class share structure means that a corporate raider can accumulate a majority economic stake in a company but still not have majority voting control to replace the board. Now, further discussion relating the topic of anti-takeover actions. A company might also restrict the ability of shareholders to replace the incumbent board by adopting a staggered board or classified board. A staggered board structure prevents a corporate raider from gaining majority control of a board in a single year. The coupling of poison pill with a staggered board is a very formidable anti-takeover defense. Now, as a practical example relating the topic of anti-takeover actions, it had been reported that a vast majority of United States corporations have adopted some level of protection. Among companies in the Russell 2000, 53% have a staggered board, 10% have multiple classes of shares with unequal voting rights, and 9% have a poison pill protection in place. Now we will discuss the sixth and the last topic of this lecture, which is warding off unwanted acquirers. The key issue for the board is to determine whether maintaining control over the corporation or fighting a takeover attempt is in the best interest of the shareholders. Unfortunately, the research literature on this topic is mixed and fairly inconclusive. According to the study of Bhojraj, Sengupta and Zhang in 2014, innovative companies with strong protections are less likely to engage in myopic activities such as reducing research and development expenditures and filing fewer patents. They concluded that, in contrast to prior research that predominantly documents evidence of harmful effects of anti-takeover provisions on average, the authors basically show that anti-takeover provisions can provide benefits to a subset of firms. In evaluating anti-takeover protection, shareholders and board members might consider several issues. First, how important is the market for corporate control as a disciplining mechanism in the firm's specific governance structure? Second, what are the motives of potential acquirers? And these motives consist with the long-term shareholders or stakeholder objectives of the company. Finally, are the anti-takeover provisions truly adopted to protect shareholder interests, or are they a manifestation of entrenched management? Dear students, you have to use Microsoft Teams Corporate Governance class platform to read an article 11.1. This article is letting one reason mergers fail: the two cultures aren't compatible. This is a very good article by Harvard Business Review. The article is already been uploaded on Microsoft Teams Corporate Governance class platform. So what you have to do after reading the article, you have to use Microsoft Word Online and type 1 to 2 pages article review in your own words, and then you have to turn it in under the assignments tab on Microsoft Teams class platform. Assignment 11.1 submission deadline is also been mentioned on the Microsoft Teams class platform, as well as details relating the quiz number 11, which will be inshallah online between 22nd to 26th June 2020. Class, that's the end of the lecture relating chapter number 11 of corporate governance. I hope all of you have gained knowledge relating topics and concepts we have covered in this lecture. Now you will see me in the next video lecture relating chapter number 12 of corporate governance. You all are encouraged to review the video lecture and ask questions relating this lecture on corporate governance Microsoft Teams class platform by using chat option. Until then, goodbye, Allah Hafiz.